Good morning, guys. It is smarthelping.com here. It's 8:17 on a Saturday morning. And what are we doing today? Well, uh, it's a real estate waterfall financial model with IRR hurdles that, based on the hurdles, give the sponsor a promote on their percentage share of the cash flow. So, I've already done one of these. And now this is a modified version, and there's a couple things different with it. First things off, you have a secondary split between the sponsor's cash flows. This is assuming, two different entities make up the sponsor, and then those entities also have their own structure promotes, which are manually hard coded here. Basically, you determine the cash split pari passu originally, and then manually put the percentages in for tiers one and two. Also, the difference is there's only basically two tiers here. You got pari passu, and then you got tier one and tier two. Um, and then you manually input the cash flow. So let's go ahead and just start off from the beginning. So let's say you're using this. What you do is you put your capital requirement here, you put the percentages that everybody has here, the investor, the sponsor, and then the sponsor is made up of two. You could switch this around if the investor was broken up into two pieces rather than the sponsor. Um, then you could just make this one the sponsor, or the investor this the sponsor, and then do these two just like they are. So you just put in the percentages here that of the equity that they contribute, and then you enter the IRR hurdles here, the promote here, and then the splits on the side split here. And then you would just manually put in, so month zero is the initial cash outlay. You could have months where you have multiple cash negatives, and that would just flow into each group pari passu to according to how much they've actually contribute. And this goes all the way down to 240 months or 20 years worth of cash flows. So the way it works, you've got your annual IRR. This is going to determine how the cash splits over time. The internal rate of return does change as it's different in month 23 compared to what it is in month 50, and the cash flows will determine that out and in. So we have the hurdles to trigger that. Then we have the promo. So this 65% promo basically means we're giving the sponsor a 65% boost. So they're going from 20% to 67% in tier one. And you can see, or sorry, from 20% to 33% in tier one, and then up to 66%. So you can see how this flips as you get better returns. And obviously, you could put in whatever numbers make sense for your deal or your contract for the joint venture. Now the cool part. Let's actually look at how this logic works. So you got tier zero. This is again pari passu. So this means the cash flow to investor, cash flow to sponsor is going to be based on the equity they contributed. So right now you've got 200,000 distributed from the project, 160 or 80% goes to investors, and then 20% goes to the sponsor. And then from the sponsor's portion, it's split based on, ABC Corp and XYZ Corp percentages. And you can see that right there. So these two will always equal the sponsor's cash flow, 40,000. Now let's scroll down. Now what happens with the first waterfall? Well, look at there. Now what this is saying is from after you get to month 90, the internal rate of return has broken this 12% barrier. And so, based on that, any cash flow that breaks that barrier, which is this month and this month and this month, gets split differently. And the way it's different is in now, instead of going 80-20, it's 67.33, and then between ABC and XYZ, it's 50-50. So you can see here, XYZ and ABC are 50-50. Sponsors got the 66. Investors got 134,000, which represents 67% of the 200. And so that's the first waterfall. That's how it works. If we were to change this hurdle, let's say if we were to make the hurdle less, that would mean more of the cash is split in the first hurdle than this one. So watch, this should go up. And yep, there it goes up. So now month 81 is where we start to get into tier one. And so you can see, obviously, the sponsor wants to get as high of an IRR as possible for everybody because they then get the most cash split at this beneficial tier 2 level of 66%. Now, again, that is based on these percentages that I've assumed. You could put in whatever, again, makes sense. You'll probably end up having to customize this for your own deal, which I do uh, help with. At my hourly rate, I'll do, build whatever you want based on whatever logic you have, because obviously this is logic, this is general assumptions and a general template, but often, you know, deals have their own specific things that need to be adjusted for. Now, if you didn't have any, if the sponsor or investor was not broken up into two parts, you could just put 0% here for these, and it would just be a traditional joint venture between investor sponsor, and the cash flows will go accordingly. Uh, and then we have our third tier here, or tier two, which is the final split. So in this final split, this is actually going to have the cash flows for the entire project in it, and it will pull from these first two um, upper levels to get a final version of what the cash flows should look like. So you can see in month 145, we're now splitting it so the sponsor is actually getting more of this cash since the internal return is now 18% or more. And then the split between ABC and XYZ has changed. So now ABC is getting more than XYZ. As you can see here, ABC goes from 39 up to 65. And the basic concept behind this is that you want to motivate the sponsor to get a better return for your money so that you can, go invest in other things. Uh, so that's what this incentive structure does. And if you go to the bottom, you can see the project internal rate of return is here, the monthly and the annual. And then here's the total returns. This is just saying if the investor puts in 9.6 million, they get back a total 27 million. So that's not net, that's the total back. So their net would be like 16 million or something of basically return on investment. But this is total distributions in order to get an equity multiple. This is the equity multiple here. This is the annual IRR, monthly IRR. And you can see if this changes. Let's say it's only 75,000 a month. That's going to be a lower IRR. We might not even get out of tier 0 at that point. No. So this tier 0 means everything's split. So if you look over here, it's all evenly split. So there's no differences in returns or multiples. And the cash flow is the same in tier 2 as in tier 0. The nice thing about this is it really, you simply just put in your cash flows and then it shows you the splits and you could adjust these variables. It's really nice. Let's put this up to 100,000, 105,000, see what it looks like. There you still don't get out of the first level. Let's put the IRR hurdle down to 5%. Oh, there we go. So we got out of tier 1, but you can see tier 1 is definitely not going to be broken. So they're split a little bit, but not as much variance there. Now there's one more caveat on the return summary. I've got required equity multiple. So this is if the investor, if after all the internal rate of return hurdle, all the IRR hurdles are implemented, the cash flow ends up being to the investor 18.9 total, net 9.3. This gives the equity multiple of 2. You can see they invested 9, they're getting back 18. Let's say their required multiple is 2.5. Well, this does not meet that. If that is the case, then the cash flows are readjusted to meet this multiple for the investor, and then the sponsor gets whatever's left of the cash flows. It could be even negative, and then these two are split uh, according to pari passu. And this assumes if this equity multiple is not met, then no hurdles are given. So all the hurdles are reverted back to pari passu, and the investor gets this preferred 2.5 multiple, and then everybody else gets whatever's left. And again, it's negative here. You can see ABC Corp put in 936,000. They're actually only getting back 468. They're actually having a loss of 468. So 0.5 equity multiple. An equity multiple below 1 means you don't get back as much as you put in. So let's put this back down. Let's say their equity multiple is 1.98. If our hurdle or our required equity for the investor is 1.5, then you can see now everything is split just like it is up here. And the investor's happy because they got the 1.5 multiple, and then they're happy because they're getting their promotes. And I think that's it. Trying to think if there's anything else that needs to be explained. I think we went over pretty much all that there is to go over. And if you obviously every deal is not going to be 20 years long, it might be 3 years or 2 years. You would just put blank out, clear off any months that have zero or that are not included in this, and that's fine. It won't hurt nothing. Put this back to 12. Okay, so I guess that's it. Um, if you want any of the waterfall models, I got this one, I got another one, and I got another joint venture that's not a waterfall, but it's basically looks at the entire project IRR and splits cash based on that only. All three are available for the one-time purchase of the $45, which you could get to that, download all these templates in the link below in the description box, and you only have to pay one time and you get all three of them, which the download link will have all three of them, no matter which one you buy. I feel like that's a fair price, 45 bucks. Pretty complex logic here, but you can also use it to learn. And then any customization I bill out at $75 an hour. Okay, well that should do it. I hope you guys have a great weekend, and I'll see you on the next one. Hopefully, the next week or the week after, I'm going to try and get a new financial model in for a new industry. Like I tried to do one or two of those a month. It's just time consuming, and I haven't been able to. But I will get something up here regarding that in a couple weeks, hopefully. All right, see you later.